Each day, we're moving closer and closer to the X date with no actual resolution about the debt ceiling. Sadly, even when a deal does come through, all we would have done is actually just kick the can down the road instead of actually fixing the real problem. Now, to add fuel to the fire, inflation comes in hotter than expected for April, which may possibly force the Fed into more rate hikes. So the first thing that I want to cover with you guys is inflation is actually getting a little bit worse in the month of April. Now, what I mean by this is we're going to be looking at the personal consumption expenditures and the core measure, which is both what the Fed actually looks at. Now, this is really important because in the month of April, it actually came in a little bit hotter than what the forecast was. Now, this is really important because over the past several months, the Fed has been raising rates at a very fast pace. And in that process, they've kind of broken a lot of things, most notably the banking sector, right? There's been kind of like that banking stress where we've seen a lot of large banks actually go insolvent and actually go out of business. Thankfully, they've been bought up by a lot of other big companies, thanks to like JP Morgan, and then the bank term funding program. They've somewhat fixed the problem, but basically all that they've done is that they've put a small band-aid over a large cut. Now, of course, when the Fed hinted that they were going to be taking things easy and maybe they're even going to go into a rate pause, that's when inflation comes out for April and it's hotter than expected. Now, the big thing is that it didn't rise by that much. You can see down here, when we're actually talking about it, year over year, it just went up 1%, where the forecast was 4.6%, but it actually rose to 4.7% for the core PCE. But the big thing is that core spending rose by 0.5%, which is actually the strongest increase for 2023. So not only is what the gauge that the Fed is looking at increasing, telling them that they need to continuously raise rates to cut the inflation back down to their goal of 2%, but consumer spending, nobody is actually feeling this so-called recession. And that's a big thing. So technically, you can say that we're in a recession because of that 2 negative quarter GDP decline that we had a while back. But also at the same time, we still have record low unemployment, and at the same time, consumer spending is still going up, and the stock market is holding pretty firmly to some highs. So at this point, really, it's up to who you ask. It's some people will say we're in a recession. Some people say absolutely not. Some people say we're hitting a soft landing. Some people say that we're going to crash and burn. But at this point, we're just getting a lot of mixed signals. And to kind of touch on that, when we're talking about the Fed raising rates, if you look at down here just a week ago, 82% of the market did not think that we're going to raise rates. Only 17% thought we were going to raise rates by 25 basis points or 0.25%. Literally fast forward a week later when we get this inflation data, now 64% of the market think that we're going to actually raise by 25 basis points. So things can change extremely fast in these markets, especially when bad data starts to come out. And no matter what the Fed says, they've continuously said their goal is 2% for inflation, and they're willing to put out pain into the market and into the economy to reach their goal. Now, there's absolutely, personally, I think, no chance that they go this month or even 2 months without raising rates again. Because again, if their true goal is to bring inflation down, there's no way that they're going to just kind of not raise rates as inflation is going up or coming in hotter than expected. Now, as far as the X date, or the date when the Treasury actually runs out of money, Janet Yellen has somehow been able to push that date back from June 1st to June 5th. Basically saying that if we can't come up with a resolution, June 5th is when they're not going to be able to pay any of their debts. Now, personally, I think that they're going to have a resolution. It's just sad that they're going to extend it out as much as possible. I mean, this is something that should probably honestly take one meeting to resolve, especially with how high stakes this is. Back in 2011, I mean, they've done this multiple times, but the U.S. actually lost its AAA grade rating from the S&P Global Ratings back in 2011 when this happened, when they basically came down to the last couple of hours before they actually made a deal. I think that's what they're going to do again. Really, there's no reason to drag it out this long because the only thing it does is it hurts the economy. And at the end of the day, all they're going to do is agree to raise the debt ceiling and continuously spend money irresponsibly. Now, if we actually take a look into the government spending and actually what they're spending it on, you can see that 2/3 of that money is going towards Medicare, Social Security, and interest payments alone. The interest payments alone are around 13%. Now, I do apologize for the graph. It's kind of hard to see, but I'll kind of point it out to you. So you can see since the 1950s, right around here, this blue line, this is discretionary spending, and it's dropped from 60% all the way down to around 20%. Now, these are things like government offices, military spending, infrastructure, things like that. Now, this yellow line over here at the same time in the 1950s was only accounting for around 15% and has since rose as our number one spending thing all the way up to around 55 to 60% of our total spending. Again, things like Medicare and Social Security. And this number is only going to go up because this is when the baby boomers are starting to retire. So we're going to have less people in the workforce, but we're going to have more people in retirement. And so now we're going to have to be spending more money in order to accommodate for everyone, which makes things a lot harder. And so when you ask yourself, these are also mandatory spending things. So when you pair that, Medicare and Social Security and interest payments, you're not going to really be able to easily cut budgets away from that stuff. The easiest thing, and it's what they've been doing since 1950 after World War II, is that they've been cutting from the military, they've been cutting from infrastructure, from many things similar to that. And I think that's just going to be the trend, is they're going to keep taking money away from that until we just absolutely cannot. And until that happens, who knows what the resolution will be after that. Now, another chart that I wanted to show you guys that I think is extremely important to understand is the gross federal debt as a percent of the GDP. This is basically, if you think of it in personal terms, how much debt are you holding compared to the income that you're actually producing. Now, think of it as a person. Imagine a person is making $100,000 a year, and this person is also spending $150,000 a year. Sure, they're going to get themselves into a little bit of debt after year one and then year two, and then eventually they get themselves into so much debt to where they're going to have to continuously increase their credit limits. They're going to have to ask for more loans, and eventually, instead of fixing the problem by spending less money or making more money, they just continuously add on to their debt, and then eventually, who knows what happens. And that's exactly what the US government has been doing. You can see that there was a massive increase in spending right around here in the 1940s, obviously because of World War II. Funding a war takes a lot of money. And then obviously we were smart and we started to drop that. The number got as low as 31%. So we had 31% of debt to our GDP. Ever since 2008, right around here, we've had a massive increase in the amount of money that we've been borrowing. And of course, during the COVID pandemic, you saw that it skyrocketed literally from 106% all the way to 127%. So a 20% rise in literally, what is this, from January of 2020, from January of 2019. So in 1 year, we increased our debt to GDP percentage by 20%, which is quite alarming if you really think about it. So the real thing that we have to consider here is that, one, we're not in a world war, so there's really no reason for this type of spending. But two, it's been just kicking the can down the road since the early 2000s, and it's just letting politicians and the US government spend money however they want to without really any real repercussions. And again, kind of circling back to the stock market and the Fed having to raise interest rates, when they do raise interest rates on June 13th or 14th or whenever their meeting is, there's going to be obviously more stress on the banking sector, but also I think there's going to be more stress all around, because the higher that they raise interest rates, the harder it is for businesses to take loans out, to run a successful business, and to keep their employees paid highly. Now, this NVIDIA has been the talk about everything. NVIDIA and AI, just alone, in the 1 day change in market cap, NVIDIA was higher than the entire market cap of Adobe and Nike. Now, when you really break this down and think about it, the AI boom is very similar to the dot-com bubble, whereas that's what everybody is talking about. But at the same time, it's so brand new. It's such a new market, and we're seeing a lot of companies, especially in hard times, being way overvalued for something that's completely brand new. And the markets are absolutely delusional with what's happening with the debt ceiling crisis, with inflation continuing to go up and staying at basically 4.5%. And yet you're seeing companies double and sometimes even triple during these times. And I mean, when we really break it down, I mean, just from 2 weeks ago, NVIDIA is already up 36%, which is an absolutely insane number, again, considering how large of a market cap it already is. And when you look at the S&P 500 over the 2 weeks, it's been up 1.7%. So to really pair that, NVIDIA has really been carrying the stock market. And again, the stock market did fall a little bit since right around here, the beginning of the year of 2022. We've been down around 26%, which is a favorable drop. But ever since right around October of 2022, we've been kind of ranging over in this area. But since then, we've been up 17%. So again, to say that, we could either be in a recession, we're seeing a soft landing, or we're going to see a crash and burn, nobody really knows at this point. There's a lot of mixed signals happening. But I think what we do need to see is that we need to see consumer spending come down. I think we need people to get serious about saving money, about the US government starting to spend less money than they actually make. And until we see those changes, the same old is going to happen. And we're just going to continuously kick the can down the road. And to kind of end this off, because I think the most important thing to remember is that no matter how much time you spend on the markets, no matter how much time you spend researching certain things and whatever it may be, it's really important that you don't get too caught up in the money you could have made or the money that you lost in the markets or whatever it may be. Because when you're talking about Cathie Woods and ARK Invest, that is a massive team of extremely smart people. And Cathie Woods and ARK actually missed out on NVIDIA. In early June, they owned around in early June, they sold all of their shares. They owned around 75,000 shares of NVIDIA, and you could see right around here, that's when they sold off. And since that point, NVIDIA has only climbed, and she missed out on a potential $560 billion market cap boost by NVIDIA, so almost doubling her shares. Now, you can kind of do the math on 75,000 shares at the time when she sold in January, but that's quite a bit of money. But the big thing that I want to get from you, or kind of to pass on to you at this point, is to realize that no matter how much time you spend, or how smart you are, or how many hours you put into the charts, even the smartest people, even the people that have literally masters and PhDs in the markets, they miss out on opportunities like this. Why? Because the markets are completely irrational. She talked about why they sold NVIDIA shares, because at the time in early January, the markets were coming in a downturn and NVIDIA was already overvalued. And at that point, it's already doubled its market cap at that point. So it's really crazy to put things into perspective, right? There are so many missed opportunities, but you can't get yourself hung up on that type of stuff. But that kind of wraps up the video here. That's everything that I wanted to pass on to you guys. So keep your eyes out on the markets. Inflation is continuing to rise. That means the Fed is going to continue to raise rates. And in the meantime, we have the debt ceiling chaos. I think that they're going to figure things out. But again, the longer they drag this out, the worse of an outcome we're going to see in the economy and in the markets, no matter what deal that they end up making.